Welcome back to Reg Talk UK, the podcast that helps UK banking professionals stay sharp, stay informed, and stay ahead of regulation. I'm Alex.
And I'm Jamie, and we're doing something a little different this week.
We are. This is a midweek special. We're stepping away from our usual roundup to do a proper deep dive on one single asset.
An asset that has, well, sort of quietly become systemically important to global finance. Tether, or USDT.
And it is colossal. I mean, with a circulating supply currently hovering around $185 billion, it's the world's largest stablecoin.
And it really is the definitive backbone of global crypto liquidity.
Which is why we're focusing on it. Because regardless of your role, whether it's risk, compliance, or strategy, you really must pay attention.
Absolutely. Tether is this huge US dollar stablecoin. It's used for trading, for payments all over the world. It's shaping the future of cross-border finance.
And it could either complement or, fundamentally challenge the traditional banking rails we all work with.
Right. And even if your UK bank has let's say, a zero-tolerance policy on direct crypto exposure, your clients, your partners, your payment flows, they will interact with it.
So it's that indirect exposure, the infection risk.
That's it. That potential for infection risk is the core reason we're doing this today.
Okay, let's unpack this then. For anyone who might only know Tether by name, what exactly is USDT in simple terms? How is this supposed to work?
Well, in principle, it's quite straightforward. USDT is what's called a fiat collateralized stablecoin.
Meaning it's backed by real money.
Exactly. The issuer, Tether Limited, promises to maintain a one-to-one value with the US dollar. They do that by holding equivalent reserves. Someone gives them $1, they issue one USDT token.
And that token is, in theory, redeemable for the dollar at any time.
In theory.
But that redemption part isn't so simple for most people, is it? I mean, retail users can't just knock on the door and ask for their dollar back.
No, absolutely not. That's where the institutional nature of it comes in. Direct redemption is, well, it's pretty much restricted to institutional investors who meet a minimum deposit.
Often over $100,000.
That's right. Everyone else, the retail market, the traders, they have to use crypto exchanges to swap USDT for cash or for other crypto.
And what makes this so critical is its sheer dominance.
It's huge. Tether holds about 60% of the entire stablecoin market. It's become the default global proxy for the US dollar in crypto trading and cross-border settlement.
And it mostly lives on the Tron and Ethereum blockchains.
That's where you'll find most of it.
So this massive, dominant dollar proxy, the real engine room of global crypto, it's often called an offshore shadow bank. But let's challenge that for a second.
Okay.
If 65% of its reserves are in highly liquid U.S. Treasury bills, and they're custodied by a major Wall Street firm like Cantor Fitzgerald, I mean, how shadowy can it really be? Where's the actual opacity?
That is a very sharp point. And the shadow bank label sticks because, structurally it does what a bank does. It accepts fiat deposits, it issues digital liabilities, the tokens, and then it invests those reserves.
But without the regulation.
Without any clear, harmonized banking regulation. So while the T-bills are tangible, yes, the opacity is really in the governance, the full transaction history, and crucially, the nature of the other assets backing it.
Got it.
So the key takeaway for a UK risk team is just to understand that this thing providing systemic liquidity isn't regulated like the banks we're used to. Not even close.
And that takes us straight to its profit model, which is, frankly, breathtaking.
It is.
External estimates suggest Tether made something like $13.4 billion in profit in 2024. To put that in context, that's more than asset management giant BlackRock.
It is a stunning financial engine. And the driver is, at its heart, quite simple. It's interest rate arbitrage. They take in dollars from people buying the stablecoin.
Invest those dollars into assets that earn interest, like U.S. Treasuries.
And this is the crucial part. They pay the token holders zero interest. So with rates having climbed so high, their profit margins have just exploded.
Okay, so let's scrutinize the other side of that profit coin, the reserves. What exactly is backing this $185 billion liability beyond the U.S. debt?
Right. Well, according to their last attestation, Q2 2025, they reported total reserves of about $162.6 billion against liabilities of $157.1 billion.
Which gives them that claimed excess equity buffer of about $5.5 billion.
Correct. And as you said, the bulk of it, about $105 billion or 65%, is in U.S. Treasury bills. But it's what else is in there that gets interesting.
And here's where the risk appetite really shows, because
Yeah.
this doesn't look like a traditional money market fund. It looks more like a hedge fund portfolio.
Exactly. For a start, they hold about 116 tons of physical gold, valued around $13 billion.
And then there's the crypto.
Yes. More controversially, they hold over 100,000 Bitcoin, valued anywhere between, say, 7.7 to $10 billion, depending on the market price that day.
Plus billions in secured loans.
10.1 billion in secured loans, which they state are over-collateralized.
Okay, so holding gold and especially Bitcoin, that brings in a volatility risk that you just don't get with U.S. Treasuries.
You absolutely do. And S&P Global highlighted this when they downgraded USDT to a weak stability rating in late 2025.
And those Bitcoin holdings, what, 5 or 6% of reserves? That's actually more than their entire safety buffer.
It is, which leads to what analysts call circular risk. A crypto stablecoin is partly backed by crypto itself, so if the market crashes, Tether might have to sell its Bitcoin into that falling market to meet redemptions.
Potentially making the crash even worse.
Precisely.
This whole structure and the anxiety around it, it's all wrapped up in this debate over attestations versus a full audit. For our listeners in compliance, what is the critical difference here?
This is a fundamental point. Tether provides quarterly attestations from BDO Italia. Now, the problem with an attestation is that it's just a point-in-time snapshot.
So it just says, at midnight on March 31st, this is what we had.
That's all it says. An audit, which is what regulators want, provides assurance on the controls, the governance, the historical movement of funds over the entire period. Without that full audit, which has been promised since 2017 but never delivered, we have no real visibility into how reserves might be used or moved around between those snapshots.
Which makes the figures, from a systemic risk perspective, much less reliable.
Fundamentally less reliable.
If you're finding this useful, don't forget to follow Reg Talk UK on Spotify or subscribe on YouTube. It really helps us reach more compliance professionals like you. So this history of governance issues and the audit problem, it brings us to Tether's regulatory track record and the current very high-stakes controversies.
It's fair to say they have a documented history of friction with regulators.
Yes. In 2021, the New York Attorney General fined them $18.5 million.
That was over allegations they'd borrowed from reserves to cover losses at their affiliate company, Bitfinex.
And in the same year, the U.S. CFTC fined them $41 million.
For misleading claims that the coin was fully backed between 2016 and 2018. So these concerns about the backing are not new. They are historical, substantial, and documented by global regulators.
But the real headache today seems to be around illicit finance and sanctions.
That risk is escalating, and quickly. USDT is now frequently cited as, well, the preferred vehicle for serious financial crime.
Things like sanctions evasion, especially with the Russian oil trade.
That and huge organized crime like the pig butchering scams. The stakes were raised in October 2024 when the Wall Street Journal reported the U.S. Department of Justice was investigating potential sanctions and money laundering violations.
Though Tether denies any knowledge of a formal investigation.
They vigorously deny it, yes, but the scrutiny is undeniably intense.
So what's their defense? They argue that the blockchain is actually more transparent than cash.
They do. They say they cooperate heavily with law enforcement, something like 124 agencies globally, and that they've frozen over $1 billion in illicit funds. Their CEO even claims almost daily contact with U.S. law enforcement.
The argument being you can trace transactions on a blockchain.
Right. It's easier to trace and freeze than a suitcase full of cash. But the sheer volume of illicit activity that still occurs on the platform remains a grave concern for governments.
Okay, so regardless of their efforts, let's talk about the scenario that should keep UK compliance officers awake at night.
The banking cutoff risk.
This is the systemic threat, the one that could trigger the infection risk we mentioned at the start.
Precisely. Look, Tier 1 banks, the big global names, they've largely refused to deal with Tether directly. So Tether relies on two critical choke points.
Cantor Fitzgerald in the U.S. for their key bills.
And crucially, the Bahamian private bank, Britannia Bank and Trust, for their actual dollar transfers, their fiat off-ramp.
So what happens if the U.S. Treasury decides to act?
Well, if they use something like Section 311 of the Patriot Act to designate one of those banking partners as a primary money laundering concern, Tether's access to the traditional financial system could be severed instantly.
And if that off-ramp is shut, what's the immediate real-world consequence?
Redemptions halt.
Yeah.
The peg breaks, and probably breaks violently. You could see USDT trading at 80 cents on the dollar, maybe lower.
And for the UK?
For the UK, the impact is operational and it's immediate. Any UK fintechs or payment service providers who rely on those crypto rails for cheap cross-border settlement would face catastrophic failed transactions, client margin calls, systemic disruption.
So your infection risk isn't just about your customers, it's the PSPs you service. Their failure becomes your problem.
It becomes your liquidity event. Full stop.
And we saw a strange example of this during the Silicon Valley Bank failure in 2023.
We did. It was a fascinating reversal. When SVB failed, investors fled the US-based stablecoin, USDC, because it held deposits there.
And where did they run for safety?
They ran into offshore, supposedly riskier Tether. Because at that specific moment, USDT was seen as the safer bet as it had no exposure to the US regional banking crisis. It just shows that safety is a very dynamic concept here.
Okay, that instability brings us right back to the UK. The Bank of England has been consulting on how to regulate these things. How would Tether's current model, with the gold and the Bitcoin, fare under the proposed UK rules?
Terribly. As it stands today, it wouldn't even get close.
Right.
The UK is finalizing a regime for systemic stablecoins, and the Bank of England's proposals are all about maximum safety.
Right.
They would require tokens to be backed either by deposits held directly at the central bank or by highly liquid government debt in a bankruptcy remote trust.
So Tether's model, with its secured loans, volatile Bitcoin, physical gold, it just wouldn't meet those standards.
It's completely incompatible.
Right.
And that drives a huge regulatory wedge between Tether and the traditional UK financial system.
And we're seeing a similar squeeze from the EU with their MiCA regulation.
That's right. The EU's MiCA rules require stablecoins in the bloc to hold reserves in EU banks and follow strict operational rules. Tether chose to avoid MiCA compliance.
Which led exchanges like Coinbase and Kraken in Europe to warn they might have to delist it.
Exactly. This regulatory pressure from the UK and EU is effectively cementing Tether's role as the currency of the gray market, offshore Asia, Russia, which for UK compliance teams creates a massive headache trying to monitor global payment flows.
So let's make this really actionable. If I'm leading a risk or compliance function at a UK bank, what are the non-negotiable questions I need to be asking inside the building right now?
Okay, 4 key questions. First, vendor risk. You have to ask your payment partners and fintechs if they leverage stablecoin rails for settlement. And if they do, is it a regulated stablecoin or does it include USDT exposure? You need to know.
Right. And what about those fiat off-ramps we discussed, the correspondent network?
Second question. Correspondent banking exposure. This is critical.
Yeah.
Do we have any direct or indirect correspondent banking links to the Bahamian banks known to serve as Tether, like Britannia or Deltec? That connection has to be flagged and risk-weighted immediately.
And on the sanctions side, especially with the DOJ reports.
Third, sanctions readiness. Can our screening system effectively identify and block USDT transactions if the U.S. Treasury's OFAC adds it to the SDN list? You need to know that your system is instantly reactive to a major U.S. enforcement action.
And finally, making sure this isn't just a blind spot in the overall risk framework.
That's the fourth point. Enterprise stress testing. Has a Tether peg break, triggered by a loss of banking, been included as a high-impact stress scenario in your enterprise risk framework? If you haven't modeled the failure of a $185 billion offshore entity, that gap needs closing. So, to summarize our deep dive, Tether really is this unsettling dichotomy. On one hand, it's the indispensable backbone of global crypto, earning billions in profit.
And on the other, it's a persistent, unmitigated compliance risk.
Exactly. Due to the lack of a full audit, its opaque governance, and its use in illicit finance, UK firms just cannot afford to ignore its systemic importance or the very real risk of indirect contagion.
And as a final provocative thought to leave you with, this whole discussion about an unregulated offshore shadow dollar might feel distant, but the political connections are very close to home. Recent reports have shown a major Tether shareholder has made millions in donations to UK political parties, demonstrating that the profits from this high-risk entity are finding their way directly into our political system. It links global crypto volatility directly to domestic governance.
That's all from us this week. Thanks for listening to Reg Talk UK. Until next time, stay sharp and stay compliant.